Hey, all, it is the 16th of June, which is, man, the year's going by so stinking quick. We're already past the halfway point. I don't know. Does it count as a halfway point when we're only halfway through the sixth month? I don't know. We have to get all the way through the sixth month, I think. So let me introduce our guest today, Dr. John Abernathy, professor of accounting at Kennesaw State University. How you doing, brother?
Good. Thanks for having me.
Well, thanks for agreeing to come on. I just literally hit him out of at his peripheral today. He's having a picnic with the family. I call him up like, hey, dude, I've got this information that just hit about inflation. Inflation's a big thing to me. One, I need you to help me decipher it. And two, why don't you just come on the recording with me today? So thanks for agreeing to eat fast and come jump into the recording.
My pleasure.
So we're talking from just outside Atlanta, right? Are you directly in Kennesaw?
Just north of Kennesaw. Yep, north of Atlanta, and pretty day here in Atlanta.
Yeah, we've got a hot freaking day here in Arizona. I've got, of course, Missouri in my background here, which I'm going to be at in 2 days. So everybody's going to be able to get me a live, well, not a live recording, I guess, but a recording from this site this Friday because I'm flying out there on Thursday. Got to get some stuff done. But I've shared this story 100 times, if not more, probably more than that, if you want to see how many times it's been regurgitated on podcasts. But you know, one of the big things that I've talked about on these recordings is how inflation is the friend of the real estate investor, and how I've always speculated, but didn't ever have the numbers to say that the longer you take to pay it off, the less you actually pay. Because I was debating with people who wanted 15-year loans a couple of years ago. Well, in one of those debates about that, I was on a podcast. And then after that podcast discussing my philosophy on that, I get a call from Dr. Abernathy here to say, hey, I'm John Abernathy over at Kennesaw State University. And I heard what you were talking about on there, and he wanted to talk a little bit further. And that's when we got the creation of this particular item I've shared with you guys before. So this is the man who created it. Right? I've said before, there's only two people on the planet that have it. That's me and this guy. So now we're building an app. Well, give us a couple more months. I'm hoping a couple more months. The calculators are almost done, where the app will have this. So any comments on what you had to do to get this thing constructed?
Well, it was really cool. It was, and by the way, I'm wearing my demo day shirt. I also have a I Heart Spreadsheet shirt. So, you know, if you recall, when we were spitballing all these ideas and the concept of what's the true return, and we never felt like anybody was capturing the true return. And so playing with this and putting it in spreadsheet form was really fun to look at, you know, not only just your cash on cash return, but tax savings, inflation, and then the wealth, the appreciation in the equity that you have in the house. And so it was actually fun to kind of put that on paper and you know, what we were spitballing, you know, to put numbers to it and see that our presumptions were actually true.
Yeah, and what was really cool about this, you know, because I've shared this quite a few times, right? You've got $100,000 purchase, $80,000 loan, 30-year mortgage. If you pay it off over the entire 30 years, you're only paying $60,000 back. But I mean, let's look at what 15 years does, because a lot of people are like, well, I'm going to pay less than 15. Well, you're paying more per year when the dollar's worth it's worth more, right? Well, now it's $68,000. That's an $8,000 difference to pay it off faster. You're paying off more because the dollar is worth more at the times you're paying, you know, when you're making those larger payments every year. So really, really interesting thought process there. But what I wanted to get more into this particular conversation has a lot to do with inflation. But before we get into the inflation piece, so we got some really cool stuff to discuss, guys. Where I'm going to get into talking, just let's hit the markets real quick. Let's hit the charts. And I've got to actually find my charts where I even have them. I've got so many darn screens up. It's all over the place. Let me get out of the share screen mode. Cancel that. Actually, let's go here real quick. Let's just go into what's happening with stocks, because we know what happened with stocks really pushed interest rates to jump up in these last few months. So this is February coming into March, and then when the stock market started to take its beating, we saw that massive drop from March 4th down to the 9th. That's when margin calls started to come in, and they just kept coming, and that's when people banks had to start selling their assets to be able to meet the margin calls. Because as we've discussed before, banks don't take your cash and put it in the vault and try and grow it, right? They have to put it out in the market, and it has to be put into some sort of instrument where it's going to grow. Well, when they have it out there in the stock market and you have these big losses, these drops like this, and the margin calls come in because they're not going to just put cash, direct cash, they're going to leverage it. Well, because that's what banks do, they leverage. Well, that leveraging forced that. Well, now we see, interestingly enough, March 23rd, right around March 20th, when the Fed started dumping in a lot of their capital into the mortgage-backed securities market. And we started seeing this starting to come back. Now, the one worry I have about this, we see a lot of this whipsaw, back and forth, back and forth, back and forth. I mean, look at this big drop here, these last few days. What if we end up in another spot where we have margin calls again? What's that going to do to our interest rates? So that's definitely a concern of what we might experience. So what I'm going to do is I'm going to open up the charts, and John, you can tell me if moving this over into this field is viewable. Can you see that, the mortgage-backed securities chart here?
I don't.
You don't? Okay, I'm going to stop the screen share. And then I will go back and open this one up so we can look at mortgage-backed securities and what they're doing. So here we are. So here's mortgage-backed securities. I can see they're staying flat, staying within the channel with the Fed doing their particular contribution to the mortgage-backed securities. But go right back there, March 20th, just like we were showing before, when the Fed started to kick in, stock market started to return. An interesting thing that we're finding out now, the stock market's having some big moves in these last couple of days, a lot of it because of them buying into corporate bonds. And it's the Federal Reserve putting money into corporations all of a sudden. It's one thing when you're talking about these markets that affect our economy, but now we're talking about corporations themselves. What's going to happen here? I do not know. The last show recording we did has a lot to do with one of the posts that came out by somebody on Twitter that says that the Fed's not going to stop printing until the billionaires become trillionaires. Here's potential evidence to that again, that there is an agenda, there is a goal, and it's to put that gap between us and them in reality. So at least for right now, we're seeing the mortgage-backed securities holding still fairly steady, but there's questions as to what we're going to see later on. But let's get into why we have Dr. Abernathy here to talk to us about inflation, because there is some things here that I wanted to get heavy into on, and I've got to find that particular screen that we had. Let me see here. Got to be right here. Now, you seeing the shadow stats?
There we go. Yep. Shadow stats.
So here's what I wanted to talk about. It has a lot to do with what's going on with inflation, because inflation, as we've talked about, is our friend. It's a friend to us and the real estate investment world, provided we're invested. If you're not invested yet, inflation's killing you before you start putting your money there. Once your money is placed somewhere in a long-term instrument like the 30-year fixed mortgage in a cash flowing property, that's when it starts to really, really, really help you. So break this chart down for us, man, because this is, we talked a lot about this beforehand, but and you're the one that turned me on to Shadow Stats. It's one of my favorite websites now, but I'm gonna kick some time over to you to start really breaking this one down.
Yeah, what's really interesting is this is an article that you and I and Gary Pinkerton had discussed earlier this week. We were kind of bantering about that, but it's so consistent with what you were just talking about. Is that, I mean, let's face it, without being political, our economy, we've had several months with literally zero revenues out of corporations. Our economy is not going to recover at the rate that the stock market is telling us that we're in a recovery. It's just not going to happen. And so, what you saw is if you look on the micro level, the micro movements of the market, they coincide with the infusion of capital, and then you begin to see this is the money supply. So M1 is basically just the currency in circulation. M2 is a little bit broader. It's the currency plus some savings, and then the M3 is all the Federal Reserve money, and you can begin to see how much money is just being pumped into our economy. Really, priming the pump for to get the economy restarted, and you see the effects that it has, because it begins to, those upswings in the stock market. But it's a prime recipe for inflation. And Shadow Stats has actually put out the concern of hyperinflation, which is probably would never even be considered in the United States. I can't imagine.
Yeah, hyperinflation. Yeah, that's when people are running around with wheelbarrows full of cash, right?
That's
because
right.
the cost of everything is through the roof and the value of the dollar is nothing. So hyperinflation could be a reality. Now, if hyperinflation does happen, let's just say it does, right? And you've got 30, 40 properties, right, that, your rents have gone through the roof. You're charging $5,000 a month for something that used to be $600, right? But your interest rate and your payment and your loan is still the same. You would literally, with 1 month's payment, pay that thing off if you wanted to, but you don't. You still continue to pay that little tiny amount, because the value of the dollar is pennies at that point, literally pennies that you'd be paying that back. So
yeah, that's actually when you blow the numbers up into ridiculous numbers like that, it actually makes a whole lot more sense, right? Like, you're locked into a payment of $500 a month, but if we go into hyperinflation and rent's $5,000 a month, your payment doesn't change. So
no, you're still $500. You're making $4,500 a month on that puppy,
right?
And so hyperinflation, yeah, it's definitely not something any of us want. But when a person is thinking about their business properly, and that's what this is. This is a business. All too often, I've got people calling me up saying, "What's your rate?" That's the measuring stick that they've been provided through all the marketing that's out there. The mortgage companies and the banks of the planet have tried to they can't manage their people so well to educate them well enough to understand how to take the real estate investor from a wage earner to now a business owner. That's a difficult task unless you understand the psychology of all that and understand how a person is going to run that business and do it yourself. The average banker's not doing that. You went from a teller to a loan officer at their bank. They don't get that, right? So how do you measure it? How do they give the consumer a measuring stick? By the thing the bank can control the most. What's their cost? What's their overhead? What's the rates? And they can't really control the weights that much, but they can control their margins and try and adjust that little tiny bit to make them a little bit better than the bank down the street. And that's what they made as their measuring stick for the whole world to try and figure out who they want to work with. Well, we don't even play that game. Interest rates are important, but they're not so important that your whole business hinges on it. Your people is what your business hinges on, understanding things like this. So understanding the money supply, and that, like you and I just said, we're in uncharted territory. We've never had anything on the chart right here before like that. Another real interesting chart that I thought would be something that everybody would want to see here. Well, I mean, look at here. I mean, this is money supply right here. Trillions of dollars. Look at that money supply going up from 1970s, all the way up. And this is actually showing official recessions in here as well. Look at the recessions that we've got that are popping in here. All the way back 1960s, since they've been tracking it, and we're back into a recession now. And look at the money supply, how it's spiking, just absolute insanity. One of the things I wanted, a couple different charts I wanted to hit on. Let me see if I can find the other one real here for you to get into. Okay, I'm gonna let you get into this one, and then I'm gonna go backwards to another one on page 11 that I found really fascinating. So,
this is this is how Shadow Stats. So in 1980, I think it was 80 thereabouts, we began, the government began, it changed the way they calculated the consumer price index. So the number that is reported for inflation, the calculation changed. So Shadow Stats did not change that. And I can't, tell me, do you remember what they began excluding from the calculation, Aaron?
Food costs and some energy costs. And I think there's some housing that's excluded. So the main thing being food costs, because what we're looking at right now is just the meat index is up 18%. And I think I saw something earlier that shows it higher right now.
Right,
so
right.
Food itself is up over 0.5% just in the last measuring, the last report I received.
Which is really kind of crazy when you think about it. Like, do we not have to pay for those since 1980? Have we not had to buy food and housing?
Well, that's and so Shadow Stats is still trying to be true to the actual cost of living.
Right.
show people what it is, what's happening to your actual expenses that leave your account every month for you to exist. For the federal government with the CPI and the PCE, and these are, in my opinion, mislabeled. Consumer price index, and then personal consumption expenditures index. When they exclude the things that we need most to survive, food is one of the top three, right?
Right.
Food, water, shelter. Well, I guess you need air as well, right? So some of the things you absolutely need to survive are being excluded. And what do we get out of it? We get this graph that shows that the inflation is going down. But when you put back in those things, well, look at where we're at. Now we start seeing this climbing up. The only reason they're both going down right now is because of oil prices, from what I understand.
Mm-hmm.
You're talking about oil price and the fact that people aren't driving around, right? We have people sheltering in place a lot more often, people working from home, a lot less time outside the home. Now you're seeing why they're both tracking the same direction in that. And they tend to mirror each other, but just with a bigger gap, much bigger back gap. And that's why in that tool that we were talking about before, I always use 7% as a number to factor what's happening with the dollar's value.
Well, and so if you want to interpret it, and I think this goes back to what you were saying, I think a lot of people are kind of they're underestimating the effect of inflation. And I think we've kind of been lulled into that inflation's, 1 or 2% per year. It's manageable. It's no big deal. But so if you look at our chart right there, we're looking at inflation of about 0%, according to the CPI,
mm-hmm.
whereas Shadow Stats is saying about 8%. Well, we've looked at the numbers and we've got a recipe for inflation that is cooking. 0% inflation is, if you're not planning for inflation, you're really going to be blindsided.
Oh yeah, if you think your cost of living is going to stay the same, especially when you're talking about the dollar's losing, we know it's losing value just by looking at the money supply.
Right.
And just by looking at that chart alone. And here's my favorite chart in the whole thing, and that just because of what I've been talking about with the Fed's involvement and everything. Look at this, guys. This right here is something. I'm going to see if I can zoom in on that. I should have zoomed in on the other ones. But this is showing the total assets that the Federal Reserve has. Not until they started quantitative easing back in January 2009 did we really see Fed's assets heavy. I mean, look at this. We're under $1 trillion back before 2009. Because this is all in the trillion. So right here, under $1 trillion had been invested by the Fed, started tracking in 2003. Then look, quantitative easing happened where, January 1, 2009, all the way to the end of March 2010, they put in $1.25 trillion into the mortgage-backed securities pool. That's not factoring in treasuries or any other places where the Fed injected capital. Well, look at where they peaked out at, right? And then they kept it kind of flat. So they shoved a ton of money in, they kept it going, and they kept adding and adding and adding. Now their assets continue to grow. This is just growing their assets. This is going from zero to here and then continue to add capital every month. So it's reinvesting what they're making from the mortgage-backed securities, from the treasuries. It's not like they're not getting paid anything. They're not just giving it as a gift to the economy. They are getting the return on investment associated with it. Then they reinvest plus more. Well, this reinvestment, they capped out and really kind of kept it flat 2015 to 2017. Then we get into the end of 2017 where they started the quantitative tightening, right? We're going to put in less and less and less. Kind of divested a little bit till we get to where we at now. We started getting into the point where they started shoving it right back in. And it wasn't just a gentle shove, right? They slammed it back in. Interesting how we went from, just under $1 billion up to just under $1 trillion to right around $4 trillion when they finally start kind of tapering it down. Now we're up to over $7 trillion in what, 3 months, 4 months?
Yeah,
that's crazy that we have nearly caught up with what it took them 10 years to do. They did in a quarter.
Yeah,
absolutely staggering. So if this to me is one of the best things I've seen, because I've been talking about this the entire time since all this COVID thing started happening and changes started happening in the market, Fed's reinvolvement. Now we get to see it in paper, in a chart form, and that right there is alarming. What comes to mind, John? I mean, other than just disbelief.
Well, and it's what you said, and I said earlier. What's really interesting is how all these charts line up. You know, if you were to overlay them, you would see the same story being told. You know, one of the other things to point out, one of the other things that I don't know how long we can sustain this, but if you look, the things that we're talking about also, they span you know, different political regimes. So you know, this is just our new normal. You know, we're in an election year. It's going to be crazy. Doesn't matter who wins the election. We're into a new normal. This is going to be, you know, the Fed is in the business of manipulating the money supply. This is something that we're going to be dealing with, you know, going forward at these levels until they're, you know, as long as they're sustainable, which who knows.
It's become a common accepted practice. Right?
Yeah, that's a good way of saying it.
So we, because of what happened in 2008, we wanted something, right? Because we got punched in the peripheral and didn't know what was happening. You watch The Big Short, you see that some people knew what was happening, other people didn't. And then all of a sudden, the whole world's taken to the tool shed, took a beating from this. So it was welcomed, and then it came in. Thought, okay, well, we're going to get everything back on track, but it didn't stop.
Right.
Stop it being on track. Right now, what it is dominating the money space in a massive way. So I just find it very, very fascinating to look at this. What the end result is, I have no freaking clue what the end result is. All I know is it's scaring the hell out of me. And I just tell everybody the best thing you can possibly do: build a phenomenal team, make sure you're getting really good assets, keeping your own personal expenses low. You know, keeping our expenses low when we don't have a bunch of debt. You don't have the brand new cars, you know, the fancy house that you need tomorrow's dollars to pay yesterday's bills. That is way too common in our economy. That people need tomorrow's paycheck to pay for the bill that came in last week. If you were to be well ahead of that, then we're going to have the inflation. It's going to happen. If you have the capability to exist in an inflationary environment like that, be able to feed yourself, feed your family, take care of your needs, and then have long-term instruments with the real estate investments, and the capability to thrive in a crazy inflationary environment is there. People have done it in the past. It still can happen if we get ahead of it. You know, so, you know, I've been preaching a lot to people, and I'm see if I got it here. I do, right here. Get their morning routine going. Get things happening in their life that they can control. Control yourself. Start with the master key system. I've been, you know, of course, pushing the books. John's got these. Do I have a picture of you of these books yet, John?
You don't.
Oh, damn it. We need to fix that. So we need a picture of you holding up the books. I've had a lot of people that ordered them, did that. You know, put the books up, send it to me. I put it out on social media. Anybody who's listening, who hasn't bought them, get them on Amazon. We've got the links here within the email. Shoot the picture. I'll post them up. I want the whole world to see that people are trying to make a change in their life. Start their day with intention. You know, we've also got a YouTube show coming out here soon to highlight those who have gone about their life with intention. In fact, John has helped me with some of the initial filming on some of it. Unfortunately, we had to junk it because some of the stuff was not working right, so we have to redo it. But we're going to make it even better.
All right.
Got some really cool stuff coming. I'll shoot you a test pilot that we've got going on.
Well, you know, I was thinking about it. I think it was just a ploy I helped move that refrigerator in your background. Is that the whole reason you had me up there for that?
Yeah, and the stone stairway that gets down to that place is not fun. John was having to play that, but it was cool to go see the guy over at Lowe's there in Missouri. He was pretty cool to hang out with.
Yeah.
But thank you guys for paying attention. John, thank you for taking the time away from family to be on this and explain some of this to our folks. We definitely will have you back on later to talk a little bit more about things as they progress and as we're seeing it. But also, everybody watch for the app. It's going to be coming in a few months. Myself and John have working with app builders to create an app to help you to calculate all the things you need to know about your real estate investments. And then we're going to take suggestions and keep making it better and better and better. So any parting words for us, brother?
Oh, thanks for having me. Yes. Interesting times. Literally, you know, could we have ever even imagined this 3 months ago? So that we would be sitting here having this conversation. So, lots of interesting times. I encourage everybody to stay educated.
Not to this effect. Holy crap! just absolutely insane. So thank you again, man. And we'll be circling you back around again soon.
Thank you.